Pleasure to host you again at MAGNiTT's Q3 2023 Emerging Venture Capital update on the state of venture in emerging markets. As usual, we will be running through the latest data of the reports that were published only in the last 2 weeks. I'll be sharing some of my views and thoughts, and at the end of the presentation, we'll be allowing some time for any Q&A. So if you have any, please do share them in the Q&A box as well as in the group chat, and we'll be happy to try and address them. By way of introduction, my name is Philip Bahoshy, and I'm the founder of MAGNiTT. MAGNiTT as a platform, for those of you that may be new, is a venture capital data platform where we fill the venture VC data gap across Africa, the Middle East, Pakistan, Turkey, as well as Southeast Asia, that is now available on the platform and will be included in our research and insights from 2024 onwards. In terms of an overview, I think as we did in H1, which was extremely popular and will continue to do moving forwards, I think it's very important to put things in the context of what is the global macro environment over the last 3 months, what is happening specifically in the MENA region, how that impacts the emerging venture markets in terms of trends, and finally, what are the key takeaways or things that we should be thinking about as we go into Q4. If we start with the macro, I mean, ultimately, there's 4 areas that I'm going to kind of deep dive into. What's happening with markets, what's happening with regards to interest rates and the impact that's then influencing venture capital and the general market sentiment. What is the talk of recessions and startups being shut down, which we've started seeing more data and information in Q3, and the job market in the US as an indicator of the economic activity, how has that been impacted? So these are the kind of 4 areas that I'll touch on. I shared on LinkedIn, for anyone that follows me, a post recently that was of interest in several conversations that I've had across the market. What is the impact of interest rates on, as you can see here, the red line, the Fed funds rate, the dotted line, the global venture capital funding over the last almost 20 years, and the S&P 500. And as you can see in the shaded red segments, these are the last 3 US recessions. And it's difficult to see what cause and effect is specifically, but ultimately the point that I was trying to highlight is in a period where you have rising interest rates that are as aggressive as what we have seen, you do tend to then have a lag in the market, whether it's the markets, which are the stock exchanges, that do continue to see volatility as markets increase. But then after that, a decline in both venture, in each case, as you can see, peaks then dropping leading into the US recession, as well as the overall economy. And the US recessions are a highlight of when they took place. The dot-com boom dating back to 2000, the 08 boom, the 08 crash that happened as a result of the subprime mortgage. The small recession, which people interestingly tend to forget, happened in the midst of COVID off the back of increasing interest rates that did impact both global markets and the venture capital space, albeit you can't see it here specifically because the market then was driven by the liquidity boom that was seen when interest rates declined. And so my point is, if you see where we are at now, having seen interest rates go up to close, if not higher, in the next couple of months to what we saw in the 08 crash, then we have yet to see the impact of these interest rates on the global financial markets. We have seen the decline in the global venture capital markets, which coincides with what we've seen in previous cycles. But really, how is that going to impact the wider economy? And I think that's something that we need to all be very conscious about when we look into what the predictions are for the markets moving forwards. In terms of the impact of the stock markets, what we've already seen that last year, there was a slowdown in the financial public sector driven by a slowdown in the tech stocks as interest rates went up. We saw a rally, if you were listening to our webinar in H1, that saw the S&P close to 15%, the NASDAQ was at 32%. But in Q3, and this is looking to analyze the last 3 months of July, August, and September, the public markets were somewhat range bound, which means that the AI boom that we saw, in fact, in the presentation I give in H1, 75% of the S&P growth was driven by only 7 stocks. In fact, 85% of the S&P 12% growth came from just 7 technology companies. When we look at startup shutdowns, another indicator of what's happening in the VC space specifically, this is a chart that came from Carter. And on the weekend, again, I posted from financial institutions talking about bankruptcy rates in the US and the bankruptcy index from Bloomberg, how it links to the Fed interest rates, is what you're seeing, according to Carter and their database of 50,000 companies, Q3 of this year was the highest number of bankruptcies or shutdown dissolutions of companies dating back almost to 2018. So we are seeing a challenging market where the impact of the Fed rate and increasing interest rates has clearly impacted the global economic market, but also in the venture capital space. In fact, when we talk about the money supply in the market, which really accelerated off the back of the COVID period where interest rates were completely brought down to zero to try and re-stimulate the market as we all came out of lockdown, that boom that we saw dating back to the 2020s has now gone into negative territory as interest rates are considered to be higher for longer, which is also a cause for concern. And finally, one of the things that was not very clear going into the H1 data set was the jobs claims. Everyone was still talking about how the robust market in the US, whether it's openings or jobs claims, remained relatively buoyant. Well, now in H2, going into Q3, we've begun to see an increase in the jobless claims in the US market, beginning to highlight how many people are potentially going into unemployment, another indicator of what's happening at the wider economy. Again, we'll have to see how that transpires into year end, but anything indications from the Fed has been that they're intending to keep rates higher for longer. What happens more closer to home, specifically in the MENA market? The 4 things that I'm going to touch on are oil prices, the BRICS bloc that became a big subject of discussion in Q3, a lot of interest in the Saudi, Singaporean, Saudi, Southeast Asian relations that has continued to develop, and the continued question of the Egyptian currency. So looking at oil prices, in H1, we actually talked about how there was somewhat of a decline in the oil prices compared to what they were in previous months, if not the peak of what was 2022. We have seen, even in the last 3 months, a return of the volatility, whether it's geopolitics or global demand, that the oil prices have continued to go up since we last spoke in the end of June, July, at the end of H1. So this is positive, potentially news for global sovereigns that have been big drivers of the fund of funds and other developments across the GCC, and is an indicator that continues to be a driver of the regional ecosystem or wider economy. The BRICS, which has definitely become a big subject of discussion here in the region, that's something to try and compete with the G8 or the G7. We are seeing that now the UAE, Saudi Arabia, and Egypt have been included into the wider BRICS discussion. And the question becomes, how does this try to impact global trade, potential commerce? We just had the announcement only last week, so it wasn't in Q3, of the visas of GCC geographies being able to enter other GCC geographies on a single visa. So is the opportunity with a non-G7, G8, which is considered as democratic geographies, and the BRICS are those that aren't necessarily part of that type of political mandate, creating opportunities for cross-development. And as we are very keen on the emerging venture markets, and you see that the Middle East is now part of other emerging venture markets, whether it be China, India, South Africa, wider Africa, and Southeast Asia, is this an opportunity for further trade development outside of the US and Europe? And finally, looking at Egypt, we made this point that the devaluation of the currency in Egypt is something that is a cause for concern. And how does that impact trade and the wider venture capital ecosystem, with what we have seen as somewhat of a migration of startups out of Egypt into the rest of the GCC and other markets to be able to try and raise funds and grow their businesses. So that's a little bit of an overview of the wider macro globally and regionally before we talk about the venture capital space. And sorry, the final point that we said is we are seeing more and more headlines of global growing ties politically and economically between MENA and Southeast Asia. Only last week, we've seen delegations from both Korea and Singapore. These are potential opportunities for companies that are looking to raise funds, scale, grow in both directions across Southeast Asia into MENA and MENA into Southeast Asia. Interestingly, I spoke to a Singaporean delegation last week that were looking to attract late stage companies to Singapore while also encouraging VCs that are coming with the likes of FII that have just taken place in Singapore. No doubt GPs and the story of international GPs coming to the region to raise funds, a concept that is going to continue to develop into year end, where LP funding has somewhat dried up outside of the region. So then we jump into the venture capital initiatives and the space here. We have seen, even in Q3 over the summer period, which has tended to be somewhat of a quieter period, several announcements to try and drive venture capital here in the region. We've seen budgets to support investors. SVC has been very active with regards to making investments in funds across the region. I have a slide later announcing some of the new dry powder announcements that we've seen. The garage that has been set up in Saudi Arabia to try and foster early stage investment opportunities. The UAE announced both an initiative for the Future 100 to identify companies to support and drive out of the UAE, as well as the Dubai Chamber's efforts to create a one-stop shop for startups to be able to set up, launch, and be supported in their efforts, as well as corporates playing the role of creating accelerator programs to support startups. So there have been headlines even in the summer to try and drive economic and venture activity for startups here in the region. But what does this mean for venture capital? As ever, we look to aggregate the data of the emerging venture markets. As mentioned, this is Africa, the Middle East, Pakistan, and Turkey for the time being that we cover. And you can see for the first 9 months of this year, we've now seen a close to 50% drop in the total amount of capital and a close to 40% drop in the total number of transactions. But how does that compare to the US and Europe? In these cases, we look at data that's come from CB Insights. And interestingly, the drop in funding is a little bit lower in both funding and transactions. I do have to remind our audience that the base of last year compared to the US was that Q1 of last year was where in 2022, there was the peak of investment activity here in the region, with many of the big mega deals being announced in Q1 2022, whereas the peak in the US happened in Q4 2021. So part of the difference can be accounted for what was the lag of investment activity and the base by which this 3.2 is compared to the first 9 months of last year was driven by what was a record start to 2022 here in the region. When you look at Europe, a 50% drop in invested capital and 26% drop in the number of transactions. And when we also look at the data that's available for Asia and LATAM, you can see that there's a recurring theme of an almost 40 to 50% drop in invested capital and an almost 30 to 40% or 45% drop in the number of transactions. Here in our part of the world, specifically looking at MENA, and each of these charts are a 5-year evolution of 9 months of both capital and number of transactions. You can see the actual amount of capital is lower than the last 2 previous years. But more interestingly, when you look at the total number of transactions, this is lower than the last 5 years that we've seen in terms of deal transactions. I always say transactions is a good indicator of the appetite of investors to invest. And then the total amount of capital is the bets that they're ready to make, because it's more likely to be driven by late stage investments. And here you can see that the actual appetite for investing in the MENA region has been the lowest that we've seen almost for 4 or 5 years. Similarly, when we deep dive into Africa, you can see somewhat of a similar trend, albeit the transactions are the lowest dating back to 2019. But again, both capital and the total number of transactions are almost down in both cases by 50%, 9 months compared to 9 months. And so when you put that into the context of what's happening globally, you can see a lot of red indicators in what has been a challenging year for venture capital for our region. But as I said in H1, if you want to look at it as a silver lining, or at least as a point of comparison, not out of sync of what's happening at a global level. And here you can kind of put a bit more color and detail when you're comparing both funding and deals and how you'd like to rank them across the different geographies, that there is a lot of concern going into year end as to how this is going to pan out for Q4. I think, as I'll come on to discuss in the presentation, there has been a slight pickup in activity already in Q4. But the question is, what does this tell us as we go into 2024 against the backdrop of what I've mentioned as the global economic and as well as the regional macro climate? So what are some of the key takeaways that I'm going to kind of deep down into? What is the regional VC landscape? How has it impacted different stages for both deal flow and valuations? What is happening geographically across the region? What industries, if any, are seeing invested activity? What has been the international interest in the MENA region? And what is the valuation consideration going to see in terms of the M&A activity here in the region? To start off with the overall trend by quarter. So here you see the quarterly map of funding and number of transactions across the emerging venture markets. When we spoke in H1, we saw that it was the lowest quarter for invested capital and transactions dating back to almost Q4 2020. When we look at Q3, and this will be a repeating theme as we go into the next couple of slides, Q3 did see somewhat of a rebound compared to Q2. The question is, can you consider this to be the early signs of a recovery, or is it purely that the base of Q2 was the lowest that we've seen in such a long time, that inevitably we were going to see more transactions than the lowest point? The challenging point here is the number of transactions remains lower than Q2, albeit a pickup in invested capital. So how does that compare to the global landscape? Well, when you look at CB Insights and the charts that highlight the global evolution, you see somewhat of a similar path. Q3 saw more invested capital while the number of transactions continue to decline. And if we look at the point that there is a lag in capital deployment, that the number of transactions also was the peak that we saw in Q1, we are very much in line with what's happening at a global landscape. And is the global landscape seeing a recovery, or are we going to see for the next couple of quarters, as you see from this chart, continued fluctuations across a standard base of investment activity? What we did see at an emerging venture market level was the return of some mega deals. Now, I just wrote a post on this earlier today, how in the US, if you listen to the All In podcast or you read international press and media, one of the indicators of how liquidity is going to come back into the venture capital space is if you're going to see the return of IPOs. Now in Q3, you did see 2 to 3 new IPOs and listings, albeit all of them are now at lower prices than what they were listed at. So were they good IPOs, and is the market ready to embrace the return of IPOs? One indicator, as we do not see many IPOs here in the region, is what is the late stage funding activity? What is the mega deal evolution here in the region? So it's positive to see that there were 2 transactions that happened greater than $100 million of investment. Those were Getty's investment as well as Red Rocks in South Africa. But then when you strip that out, you see another path to decline. And in fact, Q3 is lower than Q2 in terms of the investment capital, while the total number of transactions declines. So again, stripping out those mega deals, we are not in the US markets or Europe, where actually the volume, and I showed that earlier, and I actually said this at a talk I was giving to a COP28 representative yesterday, the total amount of capital in the MENA region is 1% of the total amount of capital deployed in the whole of the US. So let's put that into context. The whole of the MENA region's capital deployment is only 1% of what was transacted in the US. The challenge of that, when we look at the data, is fluctuations by mega deals are a lot more significant in our market than what would be the case necessarily in the US. Hence, they look at the IPO market as a sign of kind of liquidity deployment. Here in the MENA region, you can see that fluctuation. It takes one mega deal for it to be a good quarter. At the surface, if you looked at Q1, you would see that it was better than Q4 of last year. However, when you strip those mega deals, the underlying market tells a very different story. And yet, for the first 2 quarters, or for the first time dating back to Q4 2020 and Q1, we have not seen any mega deals happening in the MENA region over the summer months, while deal flow stayed relatively flat, albeit still the lowest dating back to 2017. And in Africa, a very similar story to what we've just said at the emerging venture market level. So all of that to be highlighting that, yes, on the surface, and many of the media picked up on the fact that Q3 was better than Q2 in terms of invested capital. And that can be seen here across the regions of MENA, Africa, as well as the geographies of Pakistan and Turkey. However, the total number of transactions saw a decline during that same period. What does that mean for valuations? So let's look at the share of the top 5 deals as a percentage of the total number of transactions. When we look at this, you see MENA has seen the lowest contribution of the biggest 5 deals. That means there are smaller deals contributing to the overall funding, consumption, or deployment in Q3, whereas in Africa, it remains relatively consistent. They've had some big deals that take the lion's share of the invested capital for that quarter. And so when you look at the overall round size evolution, and this is the total number of transactions, the general sentiment has been that there's been a shift towards earlier stage investment over late stage investment. And that is clear to see here, specifically looking at EVM, that 52% of investment deals have taken place between investments or deal size of 0 to 1 million, largely contributed by the return of accelerator programs to foster early stage investments. But despite that, we have seen a drop of 3 percentage points in Q3 compared to H1. In MENA, similarly, 44% is attributed to deals of 0 to 1 million, and 40% of investment activity is between 1 and 5 million, but again, a slight drop off in 0 to 1 million, indicating that the seed round stage is where most investment activity is tending to take place in 2023 compared to previous years. Same thing can be said here in Africa. And then as a result of that, how has that impacted mean deal size at an EVM, MENA, and Africa level? So Q3 did see a slight increase. As we said, we saw higher deployed capital against the backdrop of less number of deals. So naturally, that pure mathematical equation is that the total average, or the average mean size in Q3 is going to be higher than what it was in Q2. But you need to deep dive a little bit more, even when you look at the median levels, to the overall evolution. This is pulled out from our platform. It's the Series A and seed valuations for MENA region. And what you have seen effectively is that the seed stage valuations, driven by more investors playing at early stage to take a de-risk or risk-off appetite to earlier stage startups compared to late stage startups. The second thing is that there is more capital that's available at seed stage, driven by new fresh powder, which has been given to startups, funds in the region. And thirdly, people are basically raising also bigger rounds. Whereas what you see at Series A is a drop-off in the valuations of investments, because you're seeing less valuations, less available capital, and the ability to actually raise those funds is taking longer. What do we see when we look at some of the geographies? Interestingly, Turkey is really leading the way in terms of investment activity, largely driven by the early stage investments. That is something that has been categorized over many of the last couple of years' reports. And the UAE here in the region ranks first in terms of investment activity. Having said that, there's a 34% decrease in the average deal flow across the top 10 geographies. So clearly, year on year, that has declined. In terms of capital deployed, well, interestingly, compared to the H1 report, Turkey is now ranked first, where it was Saudi in H1, but driven by the mega deal that we saw in Getir, as well as the big investment deal that happened in South Africa. Saudi Arabia ranked second, but again, 54% was driven by the mega deals that happened earlier in the year. So like for like, we have seen a decline in investment activity across the top 10 deals. And not to repeat the point arduously, but the evolution that we have seen and the drop with a slight pickup in this particular case of deal flow transactions in the UAE is paralleling at a country level. Similarly, in the UAE, in Saudi, which did see a stronger Q3 compared to what was a very low Q2. But when we look at Egypt, that low invested capital, except for that one mega deal investment that was done in Halal in Q1, has really seen a dry up of investment activity across Egypt. So the same story again when you're comparing Q3 and Q2, but at a country level, a little bit more divergence across the individual geographies. When we could jump into industries, I think I've been saying this probably for the last 2 years, there is no real significant change in what is the most popular industry of choice. Fintech remains the most active by number of transactions. Clearly, we see that investor appetite is focused, and this is a trend that you also see in global markets as an industry of specifically here where it has yet to be disrupted, shall we say, in the same way as what we've seen in e-commerce, transport and logistics, and other areas. Fintech remains an interest with the sandboxes, with the government and regulatory push that is being done to try and drive and develop the financial services market. And similarly, when we look at financial services in terms of capital deployment, it ranks first. So people keep asking, are there hot segments? Are there hot sectors? Are there things that are changing? They may change here or there, but with the capital deployment being the lowest that we've seen dating back 3 to 4 years, really there's a standout industry and there's everything else where investment activity is beginning to happen. In terms of the investors themselves, now we are beginning to see news of new funds. For instance, Chimera Capital, Jeddah Fund of Fund have made investments in some PE entities and other VCs. Kaust has launched a $200 million fund specifically dedicated to advanced technologies in Saudi Arabia. SVC have made several announcements, not only in Q3, but throughout the year, of new funds that are looking to try and support the Saudi ecosystem, which gives a lot of interest and support for the Saudi ecosystem over the next 12 to 18 months. And we have seen some international players set up funds dedicated to the MENA region. Again, this is not an exhaustive list, it's just some of the announcements that have been made. But where we hear of a lot of international investors coming to the region to deploy funds, in fact, at an EVM level, Q3 saw, and this is a chart of the total number of institutions, whether they be VC, PE, accelerators, CVC, and corporates, the same number of institutions in Q3 that made investments as we saw in Q2, with 40% of them coming from outside of the region as opposed to from within the region. Break that down into the MENA region, we did see a slight pickup in the number of institutions that made investments, but we're still at almost 50% with 9 months worth of data compared to the interest that we saw in 2022, with only 36% of them coming from outside of the region. So I do need to dispel the myth that many people say is that we're seeing more international capital being deployed in the region. In fact, the capital that's being deployed from outside of the region is the lowest level that we've seen for almost 3 to 4 years. And a similar picture, albeit Africa has tended to historically be driven from investors from outside of the region, that the total number of investors in the region has dropped year on year almost by 50%. We do see some key players. So again, the ranking of total number of transactions. And here you can see the accelerator programs, a point that I highlighted as a red flag during the COVID year of 2020 and 2021, where accelerator programs found it difficult to be purely virtual in their activity, are now returning to offline programs and really driving early stage. Another reason why you see consistent and buoyant early stage, seed stage investments, which is basically what accelerator programs do. But in terms of capital deployed, you do see different names with STV, a prominent name, Algeria Capital, Venture Souk, and others leading the way in MENA and Africa. And finally, before we come on to some of the other predictions, exit activity. I repeat what I said in H1. We thought this would be a record year of exits. It hasn't. In fact, we've seen a decline of those exits. We talk about the interest rate environments. Interest rates do not necessarily present themselves as the ideal time at high interest rates for acquisitions. It takes a strategic investor for acquisitions to happen that have capital or a strategic interest in a startup for them to enter a market, or corporates that can actually have off-balance sheet acquisitions for a market to see more M&A activity. Now, if interest rates were to potentially decline going into next year, if investment activity picked up, where late-stage investors are able to arbitrage the challenging economic environment to consolidate markets, we might see that happen in 2024. But this trend of a declining number of M&A activity, which is tending to be more acqui-hire activity than pure M&A for strategic opportunities, we are likely to see this continued decline going into the end of 2023 before we see that activity accelerate in 2024. And that same trend has been the case in MENA as well as Africa. With actually, most interestingly on the platform, a highlighted point, the average number of years of companies has evolved. So if you were in 2021 looking to acquire a company, they were younger companies where larger startups who had raised bigger funds were acquiring competitors or local companies to consolidate their marketplace. Now they are slightly more mature companies that are being acquired that are able to potentially withstand the current market volatility. Two more things before I open it up for Q&A. We released the report in H1, which was a prediction to year end. How did we see that the investment landscape would look in 2023? This was driven by a request from several government clients that wanted to understand what they should be telling ministers in terms of the investment landscape. We basically broke this down into 6 different scenarios, a doubling down of what H1 was, a very crude calculation, H2 as a contribution of H1 historically and apply that to H2 figures, taking the trend of COVID 2020 and the slowdown of investment activity going into Q3 with a pickup in Q4, a 5-year seasonality analysis where we looked at what happens in each quarter over the last 5 years and how can that be applied with 3 scenarios. Take the best case in Q3 and Q4, the worst case in Q3 and Q4, and an average of the cases in Q3 and Q4, as well as what was the global trend from international markets and applying it to the MENA market. All of this has been removing the impact of mega deals. And when we apply that, you can see the 6 different scenarios that were put out and where we sit. We currently sit with the data that is available for MENA 9 months at the third, higher than the second 2 scenarios, which were the worst seasonality and COVID. But all of the cases, excluding mega deals, show that we will likely end up lower than the figure that we saw last year. Now, again, all it takes is 2 to 3 mega deals for the number to be skewed, but mathematically, it is going to show that we are likely to end the year considerably lower than we did last year. But let's look at some of the things that we are looking at MAGNiTT with some positivity into the last quarter. Number 1, let's continue to monitor the global macro indicators. It is a very challenging global macro environment, but are there going to be stimulus packages, both globally and regionally, to drive venture capital? The MENA outlook. Well, we've just had GITEX. It was a very active, one of the most successful number of attendees that we've seen. AGGM Financial Week is coming up. FII has just taken place. These tend to be great environments, unlike the summer where people don't tend to be here in the region, for people to engage in person, meet investors, have conversations, meet with government entities, look for opportunities to subsidize costs. So it'll be very interesting to see how that translates into data and investments. Mega deals. We have just seen in MENA 2 quarters of no mega deals. Will we be seeing, whether it's in Saudi, whether it's in the UAE, the return of $100 million investments and the return of late-stage investments that will very much show that there is a return of confidence in the market for late-stage activity, or will that remain the biggest challenge, as some of our clients tell us, for the next 12 to 18 months? And ultimately, as I highlighted, there are new funds that have been announced. That means theoretically dry powder. That means investors should be looking for opportunities to invest. Will that take 6 to 9 months before it reflects in the data, or will we see an immediate uptick in activity going into Q4 and Q1 2024? So some of the things that we are trying to work out and identify as we go into year end. And just before I jump into the Q&A, how can we help you? We understand this is a challenging environment. Our team is dedicated to supporting our clients understand the trends and identify opportunities. We now cover data across Southeast Asia, the Middle East, Africa, Pakistan, and Turkey with more than 30,000 companies, 11,000 transactions. That gives us a wealth of data to benchmark. It gives you acquisition targets, investment opportunities. It gives you an opportunity to identify investors, and for governments that are looking to try and attract investors to their regions or conferences that are attracting attendees, a wealth of data, including contact details, to be able to reach out to them. Separately, we're continuing to develop our product. You can now identify, whether it's for presentations, for due diligence, for events, a custom market map of both startups and investors. We create custom dashboards. Every single chart you've seen on this presentation can be replicated using our advanced analytics tool on the platform and can be customized in your logo, your colors on the platform based on your requirements. You can actually do valuation trends. I gave you one example of MENA seed and Series A. You can do that by geography, by region, by industry, by different stages. And ultimately, now Singaporean data is available on the platform while we look to aggregate Indonesia, the Philippines, Vietnam, as well as other Southeast Asian geographies. And if you're interested in reaching out, I'll ask the team to share in the chat, sales@magnitt.com, and one of our team can reach out. And so other things that you can look into, investor analysis while we identify funds and ROI of funds, investor profiles. There is a people directory where you can identify GPs, valuation tools on the platform, as well as fundraising trend analysis, when we can try and help you identify when is a startup likely to be fundraising in the next 12 to 18 months. And any of these things, including a visualization, are available for demos. So please don't hesitate to reach out in the wrap-up email that I send or in the chat that I'll be sending right now, as well as the enterprise page that'll be shared for you to be able to access us. So I'll stop there, including APIs. And again, if you have any questions, please don't hesitate to reach out for any of these features or information while I just stop the webinar now and take maybe a glass of water. I will also ask the team to please share in the group chat the links to the reports themselves so that I can share any of those things with you to gain access. So if there's any questions, like I said, please do share in the chat and or in the Q&A box. Can you shed some more light on accelerator programs in MENA, specifically in the UAE? So I'll ask the team to share the investor directory on the platform. You can actually filter and get a full list of accelerator programs that exist in the region, including their cohort, the success of those cohorts, and an analysis of the amount of funds that's been deployed by them. But at a high level, you have the likes of Plug and Play, you have the likes of Techstars, 500 startups, many different entities in the region that can support accelerators specifically, and there are many that are playing in that space. Adil has asked a question. It's clear that new funding is drying up globally. While part of that can definitely be attributed to broader macroeconomic conditions, I feel no one is directly addressing the issue of disillusionment in the startup space. Wow. A majority, if not all IPOs this year, were on non-profitable businesses, and it seems to be like the VC model is increasingly looking like a pump and dump scheme, leaving retail investors holding overvalued and potentially worthless equity. Right, I'm not sure that there was a question there, Adil. If you would like me to address that, I'm not an investor, so I cannot speak on behalf of investors specifically. What I can say is that there is a general sentiment in our client base that obviously scale at all costs is a model that is no longer viable. People are looking for companies that have unit economics. People are looking for entities that can get to scale. People are looking for people that have strong founding teams, which is why the general market sentiment has shifted towards early stage investment. If you think about a journey of a startup, it takes on average 7 to 8 years to exit a company. If you are making bets at early stage, you still have the hope that coming out of what is likely to be a 12 to 18 month period of economic challenge, that they will be coming out stronger. In fact, some of the companies that are able to raise funds now invest during an economic downturn, and that is really a pitch to investors that they come out much stronger if they can be efficient with those funds so that they can capitalize the economic pickup that is likely to happen in 2 to 3 years. But to your point, indeed, the challenge with IPOs, and it's why it hasn't necessarily happened here in the region, is you are putting the public into listed companies, and the challenge there is if they don't do well, that clearly it's a public concern. Rowan has asked the question, if you could kindly speak about the valuations, they are still high compared to global markets. Would this trend change? Well, it really depends where you are talking about. As I highlighted, seed stage has definitely remained strong. Series A and Series B have dropped considerably against what they were 1 or 2 years ago. But again, the last 2 years have been the highest valuations that we have seen in almost a decade. So while they have come down, they are off the back of what have been some of the highest valuations. The other thing is, and I'm assuming, Rawan, we're talking about potentially a geography like Saudi Arabia, where there is still access to capital. Obviously, the demand and supply means that people take time to bring down their valuations. People need to justify those valuations. And if there is supply of capital looking to meet the demand of capital, then those valuations remain high. So at a global level, you're seeing this impacted. You are seeing valuations coming down into the region where there are geographies of excess supply of capital, or at least readily available capital that is still likely to take time to percolate into the market. But it depends on the stage that we're speaking to specifically. Talha asked a question specifically around venture debt. No, we did not talk about venture debt here. I think it's very difficult to talk about venture debt in terms of the wider context because we have not historically seen the growth of venture debt in the region. We have seen players be more active. We had been hoping to release a report on venture debt later this year, which is now currently on hold. We will bring out our own report for our clients, but ultimately where interest rates increase to 6%, if not higher, or 5.5 to close 6%, venture debt becomes a lot more challenging because the requirement of those payments becomes much more crippling for startups. Now, we have seen big buy now, pay later companies. We have seen agri-tech companies raise both. So where late stage investment or even Series A investments can be coupled with venture debt, they need to be able to cover the interest rate payments as well. So I do think that the increasing interest rates becomes a challenge for venture debt as a product. Just going to the chat, but feel free to share in both the QA and the chat. Thank you, Tina. The question is, do you have any data on how much UAE-based investors invest in other countries in MENA or other emerging markets? I came across many investors based here that invest outside the UAE. Yes, we have that data. We have the data of all VCs and entities on the platform that invest outside of the region. You can get that as part of the platform. I don't have the data to be able to share now, but that is definitely one of the things that we map out on the analytics tool on the MAGNiTT platform, and is something that we track regularly. Do you think that this will impact CVC in the MENA region while it's still not mature? Having said that, why is fintech leading the VC space everywhere in the world while banks in MENA are still not really involved in this as CVCs? Okay, so 2 questions there. I actually think that this is a very big opportunity for CVCs. In fact, I've spoken to many clients of ours that are CVCs, as well as players that are active in this space. I think that number one, it's a maturing market, and corporates realize in the region that there are great companies that are either worth investing in and or acquiring off balance sheet. In fact, CVC is slightly more patient capital because unlike an LPGP structure that are fund-based, CVCs have different incentives. Now, startups need to be conscious that a CVC play is very different to a VC play, because clearly strategic investments either have an interest for acquisition in the future or come with different benefits to a pure LPGP VC structure. But I do think that we are beginning to see more and more telcos in the region, as well as family offices that can to a certain extent be considered be as CVC, playing more in this space than we have before. Is there more room for growth? Absolutely, but it takes time. And lest we not forget another conversation that I had when I mentioned the client or the entity that I was speaking to from Singapore. The region is relatively nascent. In fact, if you go back to the chart that I highlighted to you, and I will bring it up because it is still one of my favorite charts with regards to investment, venture capital investment, and Fed fund rates globally, that we have yet to go through an economic cycle of US recession and interest rate booms in the region. You can characterize that investments in the region are about 10 years old. So I'll just quickly pull this up for you. If you go back to this chart, we can say that the growth of venture capital in the region started around 2012 and 13. If you say that the oldest VCs in the MENA region were born out there, and therefore no VC or startup, albeit you saw the signs of increasing interest rates in COVID, which I think was the onset of what we're now experiencing before COVID happened and interest rates declined, no VC and or startup as a VC founder or GP have experienced an environment in which we have seen now. Whereas if you go to Singapore, Europe, or the US, given that the ecosystem started probably in 2005, 2006, many of which have witnessed the challenges that we've seen. So when we talk about CVCs, they're still relatively nascent. On the point of why fintech still attracts the most amount of capital, it is in many ways the largest industry that can be scaled and disrupted, because it is also a basic need and requirement. And again, we are not talking about blockchain and crypto and others that have been challenged. We are talking about remittance payments. We're talking about payment gateways, which are effectively the same as your transport and logistics and e-commerce. But in this particular case, the commodity is monetary that is being transferred against both. And here in the region, many banks have talked about playing in this space. None of them have necessarily come in full force. Some have done accelerator programs, some have looked to invest, some have done programs to support startups, but I do believe this is an area that remains ripe for disruption in the region. What is the best scenario to act in MENAT for seed, startup, prop tech incorporated in the EU, having deep estate sales transformation magnitude? Okay, well, unfortunately, I'm not an investor as such, nor do I necessarily look to give advice to startups. Ultimately, if you're looking to scale to the region, the markets that have seen the most activity, as I mentioned earlier, are the UAE and Saudi Arabia. So if these type of things are applicable to that market and you're looking to raise funds, those would be the markets that have seen the most investment activity. Love to hear your thoughts on evolving HR tech scene in the region. Just made a major news 2 days ago. Great question. I don't have too many views, so it is unfortunately a little bit too niche for me to give a particular opinion, but talent and people acquisition remains a challenge in the region, and no doubt there'll be opportunities for that. The question becomes what type of proposition in what is a highly competitive market for both offline tech in HR as online tech. But again, HR tech can span anything from performance evaluation to happiness, including recruitment. So it really depends on the subsection from that. Let me just see if there's any final questions, conscious of time. US startups are shutting doors at an increasing pace, as we're seeing a similar trend here in the region. Look, it's very difficult to capture. As we are aware at MAGNiTT, we look to try and capture all of this information and data. Carter was able to do it because a lot of these companies are listed on Carter. We did an algorithm search on MAGNiTT. There is a feature on MAGNiTT where you can filter companies by active and inactive. Our algorithm showed that in 12 months, from October 2022 to October 2023, 1,500 companies, which accounted to 50% of all funded companies in MENA, had gone from inactive to inactive in that period. Now, I cannot categorically say whether they shut down as such, and it's an algorithm that we look to continue to update and put on the platform, but that is a remarkable figure, if not a conservative figure, to the number of companies that are likely to be challenged in this economic environment. Historically, have investors been able to generate returns commensurate with the returns required for such a nascent venture? Great question. Again, something that I can't speak to as a VC. It is definitely something that we look to track. I think that I give a stat in many of my meetings with government officials. I need to update the numbers, but in rough terms, we looked at the total number of transactions over the last 10 years in the MENA region. There have been 2,500 investments that have taken place over a 10-year period that accounted for around 1,750 companies. Of that, only 6% have exited. And again, I cannot speak to the quality of that exit. And therefore, one of the biggest challenges of the region remains the return of the investments for VCs. And lest we not forget the point that I just made, that the market is 8 to 10 years in its nascency. We have also gone through COVID, and following COVID, now this current economic environment. And as we say that it usually takes 7 to 8 years for companies to exit, we have yet to see those exits. Of course, there are stories and success stories like Careem's acquisition from Uber. We've seen Amazon's acquisition of Souk. We've seen other great examples of exits in recent years. But in pure numbers, only 6% of funded companies have exited, compared to what is the equivalent number in the US of about 25%. Tina mentions one of the biggest challenges in this region is scaling due to the very diverse markets and the impact of returns. Absolutely. Whenever I get asked a question by a government official of what is the biggest challenges of the region, you speak to anyone in this space that is as part of these committees, the first one remains how to get to scale, which is why, and I was having a conversation just the other day with the founders of Careem. If you go back 10 years ago, startup founders wanted to be the dominant player in a country. Careem showed the way of how to become a dominant player across a region. The challenge of the macroeconomic environment that we've seen in the last couple of years highlights that even within a region, it may not make sense to enter every geography in that region. And one might need to cherry pick other regions where the unit economics make sense. One of the things I've been talking about a lot is if you are a startup headquartered in the UAE, operating in Saudi Arabia, is it more sensible strategically to go into Egypt, Levant, GCC, or to look at Africa or Southeast Asia, operating out of Singapore and Indonesia and cross-pollinating markets, or more ambitiously, looking at a market like India, which is hyper-competitive, but leveraging the experience that you have into bigger markets rather than trying to transcend across many smaller markets that exist in regions. And that is indeed the biggest challenge that many companies are facing. I think I'm going to end this now, but I'll ask the team again to just share, please, the different links to the reports. One of the if there's a technologies and solutions in the oil and gas sector, register the company that we want to list as an IPO. Which jurisdictions do you recommend and why? Emirates or Persian Gulf? Great question. Honestly, not something that I can answer. I think that listing in the region remains a big challenge. I think that listing in the regions is something that many of the geographies are looking to try and tackle. I think one of the challenges, the fundamental questions are companies listable before we work out whether we can change the mechanisms by which they need to list. But ultimately, listing in the region has historically always been for more traditional SME and offline businesses, not tech, which is why we've only seen one or two in the region. And even then, the ones that we've seen outside using SPACs have had their own challenges. Secondaries remains a bigger opportunity for people to get access to startups through secondary transactions rather than going full IPO listings in the short to medium term. Again, thank you very much to everyone who joined. We will be sharing a recording of this on the platform. If you have any questions, please don't hesitate to reach out. And if you would like to speak to anybody from the sales team, please don't hesitate to reach out to them at sales@magnet.com to get more insights from the platform and access to our research and analytics. Thank you very much.